Michael, there's been a lot to wrap your head around this morning. We've been getting a lot of questions in. We'll start with Regina in Sydney. She's asked if the 50% capital gains tax will be removed from 1 July 2028 or 1 July 2027, and will that CGT relief of 50% be grandfathered?
Yeah, so it's important at the outset to say none of this is financial advice or tax advice, and people will need to see what the final changes end up being as well, because this has been announced in the budget, but it has to pass through Parliament, and certain things might change before the legislation is enacted. But on that question about capital gains tax, the budget proposal is for it to change from 1 July 2027. It is effectively grandfathered because what happens is any capital gains made up to that date of 1 July 2027 will still receive the 50% discount. It's just any gains made on assets after that date won't receive the discount. So if you've owned an investment property for the last 10 years and it's gone up 50% in value, those 50% gains will be taxed at half your marginal tax rate. If it goes up another 10% after July 1, 2027 before you sell it, those capital gains will be taxed using the indexation method.
Okay, and Peter on the Gold Coast has asked, is there anything being done to increase the supply of housing?
Yeah, so the government was at pains to point out that the budget does have measures to try and increase supply. So they've got $2 billion towards increased infrastructure, things like sewerage, electrical connections, utilities for new housing developments, particularly on the urban fringe, with about $500 million of that designated to regional areas. The Housing Industry Association has welcomed that funding. They've also done a couple of other smaller things, like trying to put some more funding into getting skills recognition for migrants with construction skills to try and get them into the workforce faster and get more tradies on the job. And also the Housing Industry Association was pleased that it's now going to be free to access building standards, which could save your average trade company, your average builder, about $1,600 a year in fees that they have to pay just to access the building standards they're meant to comply with. So there's a few small things and some bigger things about trying to increase supply. The government's estimating that could add an additional 65,000 homes, according to Treasury modelling.
Now, this one's a bit of a long and complicated one, Michael, so stay with me. We've had a question from Boyd in Sydney. He says he's just paid a deposit on his first investment property and it settles in early June. He says he bought it with the full intention to negatively gear it, but since he paid a deposit before budget night, does it count as a purchase? He's then gone on to say that he's just taken on a whole lot of debt, which he says he wouldn't have signed up for. And I quote, if he'd known the government would lie and change the goalposts. So, Michael, since he's paid a deposit before budget night, does that count as a purchase?
The good news for Boyd is it does, according to the budget papers. So if you've signed a contract prior to 7:30 p.m. on May 12, 2026, then you are grandfathered for the purposes of negative gearing, as in you can still negatively gear your property. You won't be subject to the tax changes that take effect in July 2027. That's precisely for the reason that the government didn't want to be seen to be changing the goalposts on people who'd already taken investment decisions, and they also certainly didn't want to see a bunch of existing investors flood the market with properties because, if they were removed from negative gearing, they'd have to sell because they couldn't afford to maintain their investment.
Now, Nitlin, also in Sydney, wants to know, could the capital gains tax changes announced in the budget drive investors to move their investments overseas, thus potentially weakening the Australian economy?
So capital gains tax is levied as part of income tax, and it's based on where you reside rather than where the investment is made. So if I make an investment in the United States and I receive those dividends or capital gains as a resident in Australia, I will pay capital gains tax on those investments in Australia, even though the investments are in the United States. Just like if you own cryptocurrency, which have no geographical location, you still have to pay capital gains tax on any gains in Australia because you're an Australian income tax resident. So from that point of view, it shouldn't see people send investments overseas. The concern from some elements of the business community is particularly for startups that it might persuade them to move their operations overseas because they're currently using these tax breaks as an incentive to get people to work for speculative companies at lower wages, but with share options that could be very valuable if the company takes off and gets bought out or listed on a share market.